Hey guys, Tony here. Good morning. So I have been looking at this chart for the longest time, I think for the last 2-3 months, just to find certain correlations between what happened in 2008 after the market sell-off and what's happening right now. What you're looking in front of you is soybean oil futures, and after looking at literally like dozens of charts, soybean actually came to mind because I matched it up with the S&P 500, and for the most part, it's generally been following it almost, not I don't want to say price for price, but up until like in June, it was following it, and then soybean oil futures started tanking a little bit. The crazy part here is that I think naturally, if there wasn't any money going, any money from the Fed being pumped into the stock market, I think the S&P 500 would be following the same price pattern or the same momentum as the soybean oil futures. Look what happened back in 2008. You guys see soybean oil futures basically did a full correction on March 3rd, 08, right? When did the actual sell-off happen? Back in September, you already saw that drop down. And then back in September, in September 1st, that's when, in September is when the actual crash happened. And then it just kept falling from there. So, you had that first reverse MACD trigger as on the perfect sell-off. And then you essentially just kept going. And for the next maybe 4, 5, 6 months, you saw that massive drop to the downside. So, I mean, that drop from before, from peak highs, was like, actually I shouldn't even do from peak highs. I should do from the actual reverse MACD trigger, which was right there after the month close. It went down in a matter of months to peak lows of what, $28, but it dropped 61%. And what just happened recently, we had bear close month in July. So July was the very first time that this has closed on a perfect sell-off, like it did back in 2008. So 2008, what do we have? We had that bear trigger to close on the perfect sell-off. We have the Stoke creating perfect tops, and then look at the area for the reverse MACD. It's basically around the same area, around that -6.97, basically -7, right? Look at what happened. Look at where we are. We actually went higher on the drop than we were supposed to. But look at where the bear trigger is. It's exactly in the same position. The Stoke is creating clear tops. Look at that. Look at that clear top. That is a massive clear top. I'm not saying that we're, potentially gonna crash in the next 5 to 6 months, but there's a lot of funny stuff going on in the market right now. And I know I've told you guys this before. If I could use an analogy, it's basically like, it's winter and you go down the street and there's a lake there and the lake is boiling, right? So it doesn't make sense. These charts don't make sense. How is the S&P still running when everything else is showing, when everything else is triggering a bear market, right? Or it's triggering the start of a bear market. There's signs there. There are signs. And that's what I'm basically letting you guys know. And I think what might happen is, because the S&P 500 and all these other stocks are so overbought, I think that once everything starts dropping, I think if this does happen, I think the bigger losses are going to come from, big tech and the S&P 500, or generally, big tech and over leveraged stocks, because, they have to catch up to the drop. If you have, 80% of the market drop, eventually people are going to start getting liquidated, and you're going to see the huge margin calls on these big tech companies, because there's a lot of over leverage in them, right? There's a lot of margin in those. But again, just not letting us, think about anything, but keep in mind that we did have the very first bear trigger on July 1st. So the month of July, we closed officially bear for soybean oil futures. And it's a chart that's been correlating with the S&P 500 ever since its inception, basically. And it matched up. This would actually be more of a leading indicator chart as opposed to just following momentum. soybean oil futures tend to actually make the first moves, and then it ends up dropping, right? So back in September, you already had about 2 months of being in a bear market, right? Or actually 1, 2, 3, 4, 5. You're already about 6 months in of an official bear trigger, right? And then you actually had the S&P 500 crash in September, but soybean oil was already crashing for, it had its first instance back in March, and it actually started the push down in July. So a couple months earlier, like 3-4 months earlier, it started crashing down, and then 6 months later, you had the S&P 500 and the market crash. So if soybean oil futures actually come down to maybe, I was thinking something like the lines of 58, then after that actually happens, because it definitely can. The month is definitely looking super bearish, and it just looks like, even here, right? It created on the top side, on the high side, it didn't beat relative highs from the upside, right? But we just got to make sure about what's going on, because on the monthly, everything looks bearish right now. So if this does happen to close or drop down to $58.72, at least that next support zone, there's, the S&P 500 and everything else has to kind of give, because if this drops, I can definitely see, the stock market as a whole dropping significantly in like the next year or so. So there's just too many things in the market right now that are basically giving off bad signals, and big tech and the S&P 500 is essentially just kind of waving them off and be like, you know what, we don't care. We're getting constant money being pumped into our index and into our company, right? Which is fine, because I still think that big tech and the S&P 500 might still keep running towards the upside. But it's just one of those things where where it's not really a good time to be over leveraged right now, right? It's a very good time to kind of start cutting off your risk in case something does happen within the next couple months to a year. So as of right now, I am trying to deleverage as much as I can, because there's too much of a risk right now in the market. And as far as just comparing the soybean oil futures chart to the S&P 500 chart, it's kind of a leading indicator of what can happen for the oil's future. So I'll just gonna leave you guys with that. This isn't exactly like, oh, this is gonna happen or this is not gonna happen. It's more of just a, be aware of your investments, be aware of what can happen, and if you think something can happen, maybe try to deleverage yourself a little bit from margin if you do use it, or if there are certain things that, if you have too much money in the market that you can't lose, maybe start taking some of that out, because maybe something happens within the next year or so. Because the markets, at least the oil futures, are definitely starting to show a little bit of weakness on that side. So I'll see you guys later. Something to think about.